They're serious about it. They've never been taxed, so they want the money. Let's move on. Now let's talk about this example, and then let's talk about this example about giving to the charity, all right? So you have two options. Option one is to sell the security, receive the money from the sale because you sold your stock, write a check to the charity. Option two is, hey, take the stock, send it to the charity. So we're gonna go over option one first. So when you sell the security, it cost you $10,000 and it grew to $100,000. So you're a great investor, you made 90 grand. 90 grand capital gain. Remember the capital gain is at 20%. So 20% times 90 is $18,000. So when you sold this security, you incurred a tax of $18,000. You then wrote a check to the charity for $100,000. So when you write a check to the charity, you receive a tax deduction and the tax benefit was $36,680. Let's go to the bottom of the left side where it says after tax cost of gift. You see a negative 100. That means that's the money that you wrote to the charity. You see a negative 18,000. That's the money you wrote to the IRS because you sold the security. You see a positive 36,000. That's the tax benefit from donating to the charity. The net of all of that is 81,320. So that's your benefit. So you gave up 100, but this is the benefit of the net of it is 81,000. Let's look at the other side. We donate the security directly. It's the tax smart way to do it. There's no capital gain. No capital gain. Why? Because you donate the security directly to the university. Okay? Now, remember we want to remove income from the tax return? Even though we're paying 20% is better than 37%, but 0 is better than 20. So we want to remove the capital gain from the tax return. The value of the stock is 100,000. So your deduction is 100,000 to the charity. So the net of this, let's go to the bottom where it says on the right side, after tax cost of the gift is 61,000. And here's that math. 100,000 is the value of the stock because you gave that up. But you received a tax benefit of 36,680. The difference between the two scenarios is a savings of $18,000. In both cases, the charity received 100,000. That's good. That's what we wanted to do. But if we can save 18,000 in the process, let's do it in a tax smart manner. Again, we want to remove income from the tax return. Notice we're not worrying about the deductions. We want to remove the income from the tax return. So the question you have to ask yourself, can I still itemize with the personal exemptions eliminated? You guys know the personal exemptions have been repealed, okay? And the standard deduction has increased. A single person, the standard deduction is $12,400. A married couple is $24,800. So with these deductions kind of getting beat up a little bit, will you still itemize? And if you cannot, shouldn't you focus your attention on the top half of your return, which is the income section? Because if you don't itemize, you're gonna pay a lot in tax. So we want you to start focusing on the top side. So that's what we mean by changing the shift in terms of focusing on the deductions as opposed to the income. COVID-19, retirement changes. Now, when someone asks me, should they take money out of a retirement account? My default answer is always no. No. And I usually say no because that money is earmarked for retirement. And if you remove that money from earning the dividends and the capital gains, you're losing the growth potential, the multiplier of that money. So if we're in a crunch, which money do we take first in terms of this COVID situation? So the rule, in my opinion, is to take money that has already been taxed. It's not going to incur a tax bill. And you want to take money where you don't have to sell securities. Because normally in a crisis, the market comes down, your investments have come down, and if you have to sell securities, that loss that is a paper loss until you sold it becomes a realized loss. So normally we want to stay away from the retirement account, normally. So we would look at the mattress, the safe, that's money that's been taxed already. You don't have to sell securities. You would look at your savings account. You look at your checking account. You would look at the cash value in your life insurance policies that we should have. You should look there, okay? You may look at selling stock, maybe, if you don't have to pay tax on it, potentially. Remember we talked about a married couple up to 80,000. Maybe your income is lower now because of what's happening. So there are some options. So normally I would say no to retirement. This is a little different. It's a little different, okay? And I want to go through what these rules are. And again, these rules are for 2020 only. If it pertains beyond 20, I'll mention it. So the government has said, we know the stimulus is not enough. We know unemployment is going to run out. And we know a lot of you didn't get the PPP loan. So go into your retirement if you need to. And if you have to, we won't hit you with a huge tax bill. So the first bullet, you may withdraw up to 100,000 from an IRA or a sponsored retirement plan at work, 401k, 403b, the likes, without paying tax if you put the money back within 3 years. I'm gonna repeat it. They never did anything like this before. As Fatima mentioned, I've been in the game for over 25 years. I've never heard of this. You can take up to $100,000 out, pay zero tax, and you pay no penalty, okay? Now, if you take the money out, when you file your 20 return next year in 2021, you have the option to say, hey, I'm gonna write a check for this, all of it, or I want to spread my tax over a 3-year period. So let's say you took out 90,000. I'm gonna use that number, just easy to work with. Say you took out $90,000 this year. And you decide that you want to spread this over a 3-year period. At the end of the year, when you file your 20 return next year, you can report 30,000 at 90 and pay tax on that. 2021, you can report the next installment of 30, and in 22, you can report the next installment of 30. So first rule, if you put it back, no tax. If you decide to take it, you can pay the tax in full, or you can spread it out over 3 years, okay? So these are some options. I mentioned that there's no 10% penalty. Most of us under 59 and a half who've taken money out of retirement accounts, there are exceptions, we're not gonna get into that right now. You know that you pay a 10% penalty. There's no 10% penalty for this scenario, no 10% penalty. We talked about RMDs. Let's review that again. It's a little complicated, but I think I can handle it. Required minimum distributions. This is a scenario where you must take money out of your retirement account once you reach age 72. So what the slide says is that 2019 and 2020 RMDs are not required. So what do we mean by 2019? The first year that you are required to begin taking RMDs, and now that means when you turn 72, you have the option, this is the first year and the first year only, to not take that RMD and take it in the next year. So a person who became eligible, or required, I should say, to take an RMD in 19 and decided to say, you know what? I'm gonna take it in 20. I don't wanna bring it into my 19 return. Deferred income, right? That turned out to be a good move because now that 19 distribution is not required, nor is the 20 required. So in 2020, the person who pushed it out had to take 2 RMDs, the 19 and the 20. Hopefully that's clear. If someone has a question, we'll go over that. So what the government has said, they said you don't have to take an RMD this year. Now this is why I think that's such a good idea. The required minimum distribution that you're supposed to take in 20 is based on your balance from 19. Weren't most accounts higher at the end of December than they are now because of what happened in the market? So that means that you have to take a bigger percentage of your investment to satisfy an RMD that's calculated on 19 assets. So the government said that's not fair, so they said forget about it. It's a good thing. Let's move on. We talked about this new age. Now, the new age of 72 is not a part of the CARES Act. It's a part of what's called the Secure Act, which came out in early January. Whole new deal. We can spend hours, and I'm running out of time now. We can spend hours on that, so I'm gonna speed this up a little bit. 401k loans, you can take those out up to 100,000. Is this a good time to look at a Roth? Okay. In order to qualify for this special treatment, the COVID-19 distribution, you have either been tested for positive, your spouse has tested positive, you filed for unemployment benefits, your business has lost revenue because it's closed or it's shut down, hours have changed. You can't get to daycare because it doesn't exist. I believe that they're going to make the distribution, period, available to everyone. Stay tuned on that. So we have to make sure you qualify before you start getting into what I just talked about. Let's talk about this Roth IRA, okay? The Roth IRA, in my opinion, is one of the best vehicles for the middle class to prepare for retirement and to shelter themselves from taxation. The big question about a Roth IRA is, do you want to pay taxes now for the benefit of a tax-free distribution tomorrow? So we're going to look at that. Let's go through this example. Let's say that your 401k, traditional 401k, had a balance in March 1st of $130,000. March happened, we know what happened in March, the market went down, that 401k balance is now 100,000. So you was at 130, went to 100. Is this a good time to convert to a Roth? When you convert to a Roth, you pay tax, okay? You do that, that's the pain. You don't want to do that, but that's how you got to get in. The reason one would do that is because the growth from that point on is tax-free. So you have to have some pain to have some gain, and I'm not trying to rhyme, that just came out. So make sure we understand that when you convert, it's a taxable event. So should you do it? Let's go through this process.